They can go hire all the smart, they can get lots of people to quit their jobs on Wall Street and have gotten lots of people to quit their jobs on Wall Street and in Washington, D.C., in London, in Toronto. Leave your job at the bank, at the SEC, at the IRS. Come work for us. They have hired those humans and they pay them well. They have an enormous amount of work to do to sell even customers that are predisposed to using USDC to solve that payment problem. Enormous. There is zero engineering problems, none that are meaningful at all. It is sales and business problems. I have literally walked CFOs into the offices of Circle digitally, Zoom, and similar CFOs, Series B plus companies, $10 million of cash in the bank, costing them money because they're paying bank fees and they're not getting any interest on that money and the inflation, yada yada. That $10 million was going to be $9 million sooner rather than later by doing nothing. But sitting at that, the CFOs are very well aware of that. They can do math. Those CFOs were DeFi summer millionaires.
The Research Labs podcast by Sunday Pajamas.
God, I would say thank you so much for your time. I'm very fascinated with the idea that you are doing very different things. So could you give an idea as to what you are doing right now?
Sure. So, kind of the focus of my career has always been on the revenue side of businesses. So, very much, how do we go to market? How do we engage with prospects? How do you turn prospects into clients? And rinse and repeat and make that a scalable uh, operation. So the way that started off early in my career is a lot of revenue operations, and revenue operations is kind of a relatively new way to describe go to market, all the kind of back office, all the work that kind of comes behind what we would traditionally think as salespeople going out of the building, knocking on doors, engaging with customers, but all this kind of support work that's kind of gone with that. So that's typically that's kind of been the customer relationship management, so kind of CRM, whether Salesforce, HubSpot, all those different tools, and making them work well for those sales teams. So I kind of started off early in my career, kind of doing CRM stuff and supporting, you know, a bunch of account executives that are, I am that person now. They were in their mid career, and I was supporting them early in my career. And now kind of my real core focus is still there. I do a lot of it in a very frontier perspective from the type of technology companies that I go help either sell for or sell with, implement these kind of revenue operations, revenue engine tools into is, there's things in Web3, things in artificial intelligence, and a lot of the combination of the two of those things is where a lot of my focus is kind of where decentralized finance, DeFi, and AI intersect. Because the beauty of programmable money is if you program it with really smart compute. Some people like to describe that as artificial intelligence. I usually like to think it as statistics. When they intersect, you can have some really interesting outcomes, and that's a lot of where my kind of technology focuses and kind of that intersection between data and Web3. And my kind of core rule around that is how do we go to market? How do you engage the user, the community, the customer in that process to get them to utilize those tools effectively so that their business can improve and succeed and they can achieve the outcomes that they're looking to do. And if you do that well, revenue should flow, value should flow back into whoever's generating the tool. And if you do that well enough, you'll have something interesting and sustainable. And that's kind of what my kind of core focus is, building these revenue engines for these avant-garde companies. And then even more so lately been trying to apply that, trying to experiment a bit more with that with more traditional small medium sized businesses because they're kind of they're a customer set in some of the DeFi and Web3 stuff that we're doing. So trying to learn more about the customer by servicing the customer more broadly.
When you talk about DeFi, for example, uh, it's a very recent phenomenon compared to, let's say, other technologies. So could we maybe take a step back and think about uh, like the beginning of your career, maybe in the sense when you just got out of college, like what were the what did you know of the world at the time, and how did you kind of use it to build a life for yourself?
Yeah. So I finished school almost 20 years ago, sooner rather than later. Um, and I'm based in Canada. I grew up in Canada. So I went to the University of Western Ontario, which is here in Ontario, and pretty much left school, came to Toronto. Toronto is the major city in Canada. Um, Pretty much all roads in this country lead to this town that I'm in now. And so I built my entire career out of Toronto, Canada, and I started at Siemens, which is a extremely full global 100 conglomerate company out of Germany. Um, in that environment, I joined the IT outsourcing team, so pretty much the part of the firm that was running all the information technology infrastructure for Siemens globally, as well as external customers. And it kind of, as I alluded to earlier, too, I got to do all the kind of sales operations stuff of helping the senior salespeople respond to proposal requests or RFPs, run all the kind of CRM of what are we doing to this prospect? How are we moving them through the process? How do we educate them on our offering? Learn more about them and trying to tailor the what do they need? What do we do? How do those two things line up? How do we create a deal and a solution that'll help create and in the context we were, it was reasonable to call these things partnerships. We weren't running transactions. We were essentially asking our customers, stop running your information technology, your servers and all those kind of things that they would have had to have run back in the early 2000s. There was, Amazon did not exist. Amazon Web Services did not exist. I looked at spending one of my early paychecks on buying this interesting company that I used a lot at work called Google. So literally, I was sitting in my first or year or two of work in my cubicle, thinking about spending a paycheck on buying Google's IPO. So that A speaks to a little bit of age, but also one of the things I always joke about with younger people as I talk to them about the kind of career I've had, it's like my first value proposition in my first job was that I knew how to Google.
Really?
That usually gets that
Wow.
response.
Wow.
Like Google is a new thing. Like
Yeah, yeah.
I'm of the first generation of humans to go through university with search engines. And when I started university, it was like Lycos and InfoSeek. Like Google hadn't crossed that chasm yet. When I early started my career, it's like, oh, this Google thing is really amazing. And salespeople would come back and ask me questions, to do research projects about, can you tell us more about this customer? We need to understand better. I come back the next day with all this information. They'd be like, how the heck did you do that? And I would joke like, oh, I walked down to the corner with a bunch of dimes and I started dialing and and calling people on the phone. And I went to the library, and then I would admit, no, I Googled it, and that was a big part of my early career was like using front end technology to go, okay, how do we go to market better? How do we understand our customers better? Use technology. So that was really the kind of core where it started, and I kind of evolved in that for the first 5 6 years working for large corporations. So I kind of went from Siemens, the Xerox, kind of learned the sell at Xerox, which is kind of famous for that sales methodology that they had. And their kind of go to market. There was a very sales oriented organization, and kind of did a stint there, and then went back into very similar to Siemens, like IT outsourcing, large scale operations management business in Capgemini. So I essentially went from the German version to the French version of that, and a little more senior when I did it the second time. But it was learned a lot about how large enterprise works, in particular about how do they transform, how do they change, how do they absorb technology, more correctly, how they don't. It's very resistant to change. That's the kind of design of a large corporation, is to resist change. Um, and so kind of, for the last 12 or 15 years, been translating that into kind of my entrepreneurial life of, all right, how do I bring, here's what it looks like when you're a Fortune 100 back into, here's what you are when you're a Fortune zero. And how do you start moving your way up the ranks?
So when do you think the shift happened? In the sense, if you are working with Xerox, then you were having a good time. I would presume, obviously. Like, these are difficult jobs to get into. So how did you decide that, okay, I worked so hard to build this career for myself, so I'm gonna quit all of that and start something of my own?
I didn't have much choice. I was the youngest, least expensive, thus most expendable person on my team at Capgemini in 2009. So this will probably be more useful information now than it would have been a year or two ago, because we are entering another period of time where um, young people should be expecting to lose their jobs and have a very hard time entering the workforce, because we are absolutely going into, I think, at best, a recession. So I was kind of at that phase where the 2008 financial crisis kind of took a year or two to cascade out, and I was the easiest. We needed to reduce headcount. I was the cheapest and easiest to let go at that time. So it turned into, do I do an MBA? Do I go back to school and get a master's, or do I start a business? Um, and the short story of that is I chose to go become an entrepreneur, and have been doing that ever since, and haven't looked back. And I don't regret that decision. As I like to talk about my first startup as, well, it was the same amount of time and about the same amount of debt as if I had done my MBA. And I think I learned exponentially more and built a network that still serves me, which only purpose of an MBA theoretically is to build your network. Maybe you'll learn something while you're at it. Most people don't. In my experience of observing them after having worked and had consulted to a lot of MBAs who don't seem to know the first thing about how it works, which was the part that I didn't want to go learn. I'm like, oh, the last thing I need to learn about is accounting, because I'm not very good at it. But when you learn it the hard way when you run your own business.
If you have seen the crisis of 2008, right? So what were some of the markers when, like, kind of people felt that, okay, things are gonna go down? In the sense, like, some markers which we are seeing right now as well, because I feel a lot of people are comparing the current times with 2008, but worse. So, like, I don't understand it. So, like, what happened then, and how is it worse now?
Well, that's a very long story that isn't my expertise, but is my certainly my hobby to be very interested into. So I'm all too happy to go. But my experience of it as a 28-year-old, 29-year-old, so kind of getting out of the end of the start of my career, um, it was it was pretty clear that there was a bubble in the housing market in particular, and you didn't have to pay very close attention to that. And also, even experiencing that as a young adult, going, okay, how do I get into the housing market? How do I move my way through that and start to ladder up in the kind of traditional way? And you look at the prices, and you're like, well, these prices don't make any sense, because I'm pretty sure I'm making a reasonable amount of money relative to my age. And I look at the housing stock that I'm supposed to go buy, income doesn't match that financial calculation. And then you start to read the news and like, well, no, that's not unusual to you. And you start to figure out for market to work, the financing needs to carry through and convert and exit the debt.
Hmm.
Otherwise, you're just perpetuating a debt cycle. So it was just very clear that there was a housing bubble perpetuated by too easy access to credit getting cheaper and cheaper by the minute. We thought it was cheap a year ago. It was cheap. It's 3 or 4, 3. I was looking at 3 or 4% mortgage rates, and that's like you don't need to be a math genius to go. That's close to free. Um, and it got lower, and there was a bunch of structural stuff that politicians did through trying to increase access to housing, trying to increase financial inclusion, all that kind of stuff with good intent, but created a bunch of misaligned, perverse incentives inside the financial market that allowed way too many people to get way too much debt. And then that got exploited by the financialization of all things. And so that blew up. I my short version of where we're at now is none of that problem was solved in 2008, 2009. It was paved over with quantitative easing, all the different mechanisms that you can go listen to a macroeconomics podcast with Ray Dalio to give you much better explanations than myself. But essentially, the political will was not there to suffer the pain and have go through one election cycle to the next election cycle inside that financial crisis. So as we all know now, very clearly, you don't have to pay much attention to anything to go like they printed a lot of money, which just you know pushed it incredibly far down the road. I don't think anyone expected because they kept perpetuating through QE and all that kind of again nerdy macroeconomic stuff. Kept pushing it down the road, and we're like near 20 years down we're 10 years down the road minimally
Yeah.
from the same crisis. And like stocks, bond, everything you can think to buy with money is inflated, and in a bubble it's going to pop. And I don't believe that we have new tools to go solve that problem because we fired that bullet 13 years ago. And it's going to run out of runway.
Yeah, we were doing that again during the pandemic, in the sense there was a lot of money printing that happened to pay for the pandemic.
Put it on steroids.
Yeah, yeah, yeah. So, a lot of times there are discussions that all the mistakes, financial mistakes that we are doing right now, they have to be paid someday. So maybe the next generations will pay for it. And when you think of, let's say, macroeconomics, right, it all feels like an endless game, in the sense, just print more money and solve the problem right now. We'll deal with the consequences later. So how long do you think we can keep on pushing things like that? Or do you feel that, it will come to an end someday, maybe?
We're in the end phase. So there's a couple combinations that intersect there. So again, an easy way to anchor that is the baby boomers. The baby boomers are all retiring. My parents were the youngest cohort of baby boomers. The president of the United States is the oldest baby boomer. They will extract all of the wealth out of the ecosystem in order to keep themselves alive as long as possible because that is human nature. Um, so we got 30 years of workout of the economic engine of the world since the war 80 years ago, their lifetime, Joe Biden's lifetime ago, is going to extract all that wealth to, in Canada, in the United Kingdom, in France, places like that where we have socialized medicine. Those socialized medicine systems only have one outcome that's predictable: bankruptcy. Because end of life is when all that money gets spent, yada yada, and all those people are approaching end of life, and so they're going to extract all that wealth out because they're becoming literally becoming non-productive as they retire. They're also blocking the next generation from taking leadership and taking getting those executive pay packages, Again, the president of the United States is like 80 years old. Um, so you look at what just happened in the UK. There's literally person who just became prime minister is exactly my age. So it's kind of like, are we old millennials or young Gen X's? Debatable. I'd say we're young Gen X's are now being handed the bag um, from the boomer generation to a degree, and we're gonna have to work with you millennials to figure out how do we work our way out of this without getting into a shooting war, which we're already in a shooting war. And the every other, I'm a history major, so I do know something about history. Where it is 1913, and what happened in 1914 was World War One. It was violent, excruciatingly violent. And World War Two was just an output of World War One. There was no new news in World War Two. It was just we didn't solve the problem. Um, so hopefully 2008 was World War One, and now we're just in World War Two, and it's mostly financial, and it's we're not going to blow each other up too extremely. Obviously, Ukraine is an outlier to that. Hopefully, an outlier to that, but not the precursor starting point. Franz Ferdinand like moments of these things, of which there's definite efforts amongst our elites to make that so. Um, whether on purpose or not is a whole other interesting conspiracy debate that's not worth getting into. But there's all kinds of dominoes that can start to knock down, and boom, the economy will not be our problem. Not getting killed on the front line will be our problem.
I think in 2008 you were really young and you dealt with it. You started a business during the crisis, right? So how in the sense, how does it feel like in your head when you were doing it? Is it like a lot of fear because of uncertainty of how things are going? Like how do you deal with something like that when you are so young?
Fear, uncertainty, and doubt. So an enormous amount of FUD, fear, uncertainty, and doubt was a part of that process, and so um, it, it it was the defining outcome, maturing moment of my adult life anyway. Because business failed, I had a relationship failed at the same time that the business was failing, my bank account was failing. Um, it was extremely It was depressing, it was frustrating, it was all kinds of pain. Um, and kind of the going through that process, as I somewhat joked about, but was very real and still sticks with me. It was like I got way more out of it than if I had gone and done an MBA. I learned an incredible amount, both about my own psychology, my way of working, my way of being, what I wanted to be, who I wanted to be associated with and working with in that environment was became really clear through going through the crucible of failing at a startup and failing at a startup in between 2009 and 2011 when the economy was not in one's favor. Things were not easy to build at that time because money was tight and every potential customer was holding their money close to the vest and trying to make sure that they're always only spending on what they need to be spending on, and that's a very different environment than we've lived in for the last 10 years. Um, but surviving it, one of the when people ask me like, what's my proudest accomplishment as an entrepreneur, is like mine is that I've survived. I've been doing it for 13 years. Most people who can say they've been an entrepreneur, startup founder type professional for 13 years plus of somewhere along the lines of had a meaningful large exit that's kind of given them personal financial security, or are inside of companies that have raised enough capital, generated enough traction, gotten big enough where they're making the same kind of money they would be making plus getting a huge equity upside on top of it that they would be getting if they gone and worked at a large corporation. So they suffered for 5 years in order to get back on track from a salary perspective, and then getting those equity outcomes can make them very wealthy and give them a lot of security. I've made a living. I've had some good outcomes, but I've never sold the company for enough enough to put millions of dollars in my bank account where I can sit back and collect my dividends. It's always been on to the next project, on to the next startup, and trying to keep the lights on and perpetuate fairly a solid lifestyle. But it's just been staying in the game has been my biggest accomplishment. The only way I've been able to do that and suffer the fear, uncertainty, and doubt that still exists with that 13 years ago was the you know going through the gates of Mordor in 2009 and 10 was why I can sit back and look at this now and go, okay, been there, done that. Uh, I know where a bunch of the pitfalls are, and I probably can avoid a few of them, and hopefully get to the other side again and do so successfully. Yeah, so I think if I was 28 again, looking in the environment we're facing now, it's I think there's three three obvious options. There's more options than three, I'm sure. Of you can get safe and go find the most secure job you can find. Hold on to it. Work your hardest at it, because the good news is you're inexpensive relative to you know people 10 years older than you, obviously. Um, so it's learning how to get really skilled, really practical, really useful in those environments so that you can survive, um, and kind of weather the storm that we're going to go through. But I would, those who have a lot of fear, uncertainty, and doubt relative to the situation, that is the solution. Is if the government wants to give you a job, take it. If you can get a gig at Microsoft, take it. It is dig yourself into you know the environments that are highly probable to survive what may come, and be as useful as possible, be as practical as possible in those environments, because the good news is you have just enough experience to be useful, but not enough experience to be expensive, and take advantage of that. So the next most logical option is go to school. We can go to school, not great advice for Americans generally, but everybody else in the world. Go to school, try not to get in any material amount of student debt, but obviously use the debt instruments that are available to you to have a life, pay for your tuition, but go back to school, do that for the next 2 years, wait it out, make yourself more practical on the other side. I'm not a massive proponent of academic outcomes, but if you can go back to school and become a doctor, there's no question being a doctor will be a perfectly viable tradition. Going back and do your MBA, like I don't think there's any value in an MBA unless it's from Stanford or Harvard or maybe six other I say companies because that's what they are. Yeah, getting an MBA from the University of Western Ontario, not useful. Getting it from the University of Illinois, not useful. University of Mumbai, probably not useful. Um, Either get a really practical degree, um, or avoid school. The third way is what I chose, and obviously my biases is make your own business, figure out what it is. If you're, but it's the environment we're in. You will not raise venture capital. Should be your assumption. Doesn't mean you don't try. Doesn't mean you don't position yourself for that opportunity to sell equity in a venture capital perspective. But you got to be hyper practical, hyper revenue focused. What problem can we go solve for a segment of customers, even if it's just you? So if you're in North America, you probably need to figure out, how do I get $2,500 to $5,000 a month into your bank account to pay for rent and food and car or whatever else, have a basic lifestyle. That's There's a lot of ways to freelance, hustle, build micro products that go generate that kind of income. The less dependency you have on anybody but your customers, the better. So onboarding employees means you gotta be able to pay for those employees. Taking other people's money from an investment perspective means you get a great result for them. I get really practical, really tight. Find a service offering, a product offering that you can deliver, or you and a small team can deliver with enough margin for you to support yourself and drive that through. I wouldn't be hyper interested, joining a funded startup, provided they know how to sell product to the customer. They figure that out. They have product market fit. And this is advice, whether you're an engineer, an accountant, a lawyer, or a salesperson, it's like, do not think about joining a startup in these market conditions that does not have product market fit. Go and join them, help them perpetuate, scale that product market fit. If you do that in this market, it'll be a very successful outcome. Most companies will not be successful. So the only way to kind of judge that and get a relative bead on, is this worth the next 3 years of your life, is do the customers of that startup believe in it, need it. So meaning when their budget's constrained and cut, does the product the startup sell survive that cut? And pretty much if it doesn't make them money or save them money, it will get cut. So if it's human resource management software, it better help manage that HR to help them reduce the HR expense. If it's a CRM, it better help the salespeople sell. It's got to be about doing things better, faster, cheaper. Doing more with less will be the entire theme, and the market has not done more with less since somewhere around 2011, 2012. We are a decade of business leadership having essentially open spigots of cash, therefore very, very, very little notion of spend management, optimization around that. Most businesses just have been throwing money either through the format of get more humans, throw more humans at it, throw more software at it, throw more whatever at it, because cash has been cheap. Cash is now expensive. They're going to do more. They're going to do more with less, and pretty much anybody who's started their career after 2010 hasn't experienced that. And the vast majority of middle management, or more my age, they're that 35 to 45-year-old cohort, are the directors, the VPs of most companies. They have not experienced winter. Privation has not been an element of it. A little bit at the start was like, okay, this is tight, but the rise through the ranks has been easy breezy. Just show up
I
with a
see.
pulse,
Yeah.
collect the check. It's been a lot of it. That's not to demean the work that had to go into it, but because it's competitive. But the business environment's been very easy. So prepare for winter. It will be cold. Food will be scarce.
So actually, when you were sharing that you should only join a startup that has achieved product market fit, and I was kind of thinking about, asking about product market fit because you're working not as an entrepreneur but also as a VC now. So I'm sure you must be, coming across a lot of founders who are maybe not there yet when it comes to product market fit, or they are overestimating product market fit. And I'm sure everybody who is in this space can see the number of founders who kind of make a mistake of feeling that they have achieved the fit but they are not quite there yet.
It is not a simple. There's no math. There might be. There's not too many math equations that says you have product market fit. Um, it's one of those things, you know it when you see it. It's the job of venture capital. It's the job of um, job of the founders, frankly, to go, we have product market fit. And it's a see, it's a know when you see it, and it shows up in in the model it's perpetuated for the last 10, 15 years. The growth number tells you if you're growing, if you're on a 300% year over year AI, a current reoccurring revenue growth rate, you have product market fit. If you have 75%, and you probably don't. Like that number should only start coming off that 300% target
Hmm.
like, when you have $100 million+ of annual recurring revenue.
Got it. Yeah,
And the only reason that number starts to bend or curve down at that point is because you are starting to run out of TAM. There's always you've talked to all of the realistically interesting customers in your market space once you're kind of in that zone for a lot, depending on the product. But if you're a business productivity product, things like that, it's like we've talked to the entire Fortune 2000, and you're in the hundreds of millions of dollars of revenue, and it's like, okay, that might not grow 300% year over year, but like if you're $1 million ARR, eh, if you're talking to a company, if they have $1 million ARR, they've probably raised venture capital. They could probably afford to pay you a reasonable salary. They're not going to pay you a great salary, but pay you a reasonable salary. And the only viable survival bias of that $1 million a year revenue company is to get to 3 million.
I see. Yeah.
And really, it's five.
Hmm.
And this is math. Like I know there's lots of people in the world that are good at math. It's like the multiple that generates the market cap of a company like Salesforce.com or ServiceNow or Facebook. Pick your market segment that your startup that you're looking at joining or start or being is in.
Yeah,
Check the growth. Salesforce doesn't grow at 300% anymore, but it grows at like a really impressive clip at billions of dollars of ARR. That only gets multiplied so much in the future. It's like the thing I can guarantee you, as sure as gravity, Salesforce will make money next year. A lot of it.
I see.
EBITDA. So if you're going to go join a CRM startup, it's like, that's the comparable. Venture capital is only going to value that company and raise the next round of company, which means that you can continue to be employed, get a raise, have your equity be worth something. If it doesn't just go from 1 million to 3 million, because 1 million to 3 million in that market space wouldn't be that interesting. Probably find somebody to invest in it, but Sequoia is not going to invest in it unless you get like 5, 6, $7 million of ARR, which is crazy hard. In good conditions, that's crazy hard.
So, with the current conditions, right, and with the VC funding kind of dwindling, what do you do with what do you think it's gonna do to the companies who are out there right now? Like you see mass layoffs left, right, center.
Yeah, huge amount of mortality. So companies that rely on investor capital are gonna die. There'll be all kinds of interesting exceptions to that rule. They'll make for fun TechCrunch articles.
Yeah, yeah,
But if you're there, they'll make for an interesting story about
on HBO probably.
the mess that they would be on HBO. Companies that know how to sell value to their client and extract enough value in return that generates a net profit survive. How much they survive, how well they survive, what the equity value is on the other side of that survival. But if they survive through the next 3 years, 1 to 3 years, good, those companies are going to get really well valued again. Um, I look at environment I've spent a lot of time in, and I'm very bullish on the technology and the ethos of the community, but the majority of Web3, crypto, DeFi, NFT
Yeah.
startups are delusional because, and it's the market has given them signals to teach them that delusion.
Hmm.
Most of the founders and leaders of Web3 projects have not seen winter.
Yeah.
They have lived in a free money economy. You're a smart engineer with a good idea. Here's the venture capital. We'll buy your ICO, your NFT, your total liquidity value floats. Money will flow into these things because everyone's just like, okay, show me where there's a smart 25 to 35-year-old engineering or ex finance person who can write a smart contract, and they'll fund it. That boat literally will not float in this environment. Most of those entrepreneurs don't know what it is to operate a business in a practical sense. They've only like, and I could say this of Silicon Valley people in that generation. Forget Web3. It's like spend as much money as we need to acquire as many customers so that our equity number goes up. That was the incentive model. There was the making a profit was a bad idea
Yeah.
for the last 10 years in a software as a service business. You were doing it incorrectly if you were making a profit.
Yeah. Yeah. Yeah.
You need some unit economics that generate some gross margins. You can reinvest the gross margin into the growth vehicle. But because your revenue was being valued in equity terms at, geez, at the low end 10, when we hit the peak at 100 times forward trading the ARR number. So if you had $1 million of annual recurring revenue, you were $100 million valuation business. The incentive model was to take all of that capital you just raised, shove it down the pipe to make the $1 million number turn into a $3 million number, into a $5 million number. The potential profitability of that was irrelevant.
Yeah. And I would say particularly ask you this because during the course of the last month, I have been talking to a lot of Web3 founders, particularly who are very smart blockchain engineers, right? And they were working in the NFT space. And I kind of asked them, like, what are your thoughts on the current, I would say, crypto environment? And all of them kind of admitted that they kind of are getting forced not just by the market but also the people who have funded in the companies to focus on something that will actually make a profit. And the way they are kind of doing it is, okay, let's try to go hardcore on building the technology and not on things like, oh, let's build an NFT project right now as a company.
So there's an ethos that arose from the last bear market in crypto, so 2018, 19, a little bit 20, of which I went through that. I started full time professionally in Web3, crypto, blockchain, whatever we'd like to call it. In 2017, built three companies in the space, two of which done well, and third that died um, because we couldn't find we found product market fit. We were very convinced we were never going to find product profit fit in that model. So we killed it because profit is how the engineers, the community eat. Value must be accrued into the protocol.
Yeah.
Net. Whatever it takes to produce the value that gets consumed must get value returned to it net incrementally more. Otherwise, it dies. If your JPEGs do not increase the value of the ecosystem around the JPEGs, eventually all of the good vibes of the community will go find somewhere else where the good vibes will sustain them financially. I have JPEGs in my wallet that I like and they feel good, and I bought them, and whether they're worth 1 ETH or 0.001 ETH. I don't particularly care. But the ones that are worth 0.001, I'm not paying attention to. And if you're in the Discord server, like, cool. I'm glad that you found a chat form that's fun. Um, it's a better idea than hanging out in Facebook groups or something like that. The and so the ethos that got built in that kind of first bear market that most people experienced was put your head down and build, because if you can survive the winter phase, you'll come out on the other side. And congratulations, your Uniswap. Congratulations, your OpenSea. Congratulations, your Polkadot. Congratulations, your any other number of DeFi NFT summer success stories. Because the only reason those pieces of technology were there well enough to be the winners of those of NFTs of DeFi summer in 2020 was that they spent the winter of 18 and 19 building it. And so there's an ethos, and there will be winners of that who just, if they're building the right technology, that will work. The vast majority of humans in this market space are copycats. Good, and there's a good, bad, and indifferent discussion of copycatting. Like, Sushi Swap works. I'd rather use Uniswap, and Uniswap's going to accrue. The Uniswap community will accrue more value than Sushi Swap because Uniswap built it, Sushi Swap copied it. They do different things, and there's different stuff around that, and there's all kinds of ways to go down those rabbit holes. But like, finding what job does this piece of technology do? Communications is technology. So memes are tech. How do I monetize the meme? How do I monetize the smart contract? How do I monetize the infrastructure that underpins those things? Is cash flow is cash flow is cash flow, whether you denominate it ETH, Solana, DAI, dollars, doesn't matter. There's at least probably 5 to 15 humans trying to create the value, which means somewhere in the neighborhood of $1 million of value needs to come back in net for them to be paid to survive and keep building and reinvest in making the thing better. Business, I have yet to see a model that defies the logic of business.
Yeah. Like eventually it kind of goes down.
There's all kinds of new dynamics, and there's all kinds of new edges to how you can run a business and make value and contribute value and create a sustaining ecosystem. But whatever it costs to sustain it, you need to return more of it back in. That's just physics. The energy of the system requires input, and the only path that any technology ever, to my knowledge, I'd love to hear an example otherwise, has ever been adopted at anything that resembles scale is through sales. The person who invented the wheel 40,000 years ago probably didn't ever achieve any value for it. It was probably the person's grandchild who finally got the neighbors to go, the wheel's a really good idea.
Hmm. Yeah, yeah.
We should get that guy to make us a wheel. Maybe we'll trade him a cow for his wheel. The neighbors of the guy who invented the wheel looked at him going, he's crazy. You can just carry stuff. I guarantee it. Someone had to figure out how to sell the neighbors of that farm a wheel. And it took a long time. Good news, modern technology, instead of 3 generations, my wheel example, there was probably some historian who has some real example of how that actually worked, but I guarantee the wheel got sold and it took a long time, the adoption. It might take 3 months of, I built the newest, coolest widget that does a thing that's valuable to the market. It's going to take 3 months for me to tell the world that that's the case, get some adoption on it. But like the crossing of the chasm, it's taken Bitcoin 12 years to cross the chasm. Every banker on earth knows what Bitcoin is. Every meaningful bank on earth is engaged with Bitcoin in some way, shape, or form. Ethereum is barely registered in those markets. These are financial products. The consumers of financial products at scale on this planet are banks. If you think your DeFi protocol is cool, but you don't have bankers using it, you haven't sold. Pardon my language. There are very front edge bankers, and I'm using bankers very broadly, that know what Uniswap is, have used it, have experimented with it, haven't onboarded any of the fiduciary responsibilities inside of the bank that they work at or the financial institution that they work at into Uniswap, but they certainly have used it and have an opinion about it and can educate and are actively educating the stakeholders inside their financial institution about Uniswap's really powerful. We should really use it. We can do a lot of things that are important to us, better, faster, and cheaper, that will make us more profitable and allow us to expand our book of business, that will make us more money so that you will pay me my bonus. Because that is the only thing a rational human inside of a business cares about.
Yeah, yeah, yeah.
And like the great example of this is like Circle. No one on earth should use the Swift network. It's definitively dumb. It's like a farmer carrying stuff up the hill when they can use a wheelbarrow. It's stupid. T plus three, $40 fee on each side, plus the foreign currency exchange rate that any bank on earth is going to give you is crap. I can go on Polygon network right now and send you USDC instantaneously for 4 cents.
Yeah, yeah, yeah.
Why on earth anyone would choose a payment rail remotely different than that? It defies logic. It will take some version of that 3 generations. The generations of time have compressed, and it might take another 3 quarters or 3 years for the majority of businesses on earth go like, why would I ever transact through Swift? That's just dumb. The trick is like Circle is as well financed as any other company in Web3. They can go hire all the smart, they can get lots of people to quit their jobs on Wall Street, and have gotten lots of people to quit their jobs on Wall Street and in Washington, D.C., in London, in Toronto. Leave your job at the bank, at the SEC, at the IRS. Come work for us. They have hired those humans and they pay them well. They have an enormous amount of work to do to sell even customers that are predisposed to using USDC to solve that payment problem. Enormous. There is zero engineering problems, none that are meaningful at all. It is sales and business problems. I have literally walked CFOs into the offices of Circle digitally, through Zoom, and similar CFOs, Series B plus companies, $10 million of cash in the bank, costing them money because they're paying bank fees, and they're not getting any interest on that money, and the inflation, yada yada. That $10 million was going to be $9 million sooner rather than later by doing nothing. But sitting at that, the CFOs are very well aware of that. They can do math. Those CFOs were DeFi summer millionaires.
Wow.
They spent the summer and the year following on their own time and their own money. They put 20 grand or 50 grand or whatever they could afford personally to put into Uniswap or any other of the DeFi protocols, and converted that into millions of dollars, to the point where it's like they're quitting their job at big four accounting firms because they were smart. They're not sitting on tokens that are down 80%. They took the profits and turned it into USDC, and that USDC is sitting staked, making them 6 to 8 points APY.
Yeah.
It's nice living. So they're like, they were acutely aware of, I leave money in fully registered, all the usual rigmarole bank, my $10 million would be significantly less than $10 million in 1 year. If I put it into USDC, I will have $10 million in 10.8 million, or 10, I'll have $80,000 of additional interest in my bank account. $80,000 buys a marketing person for free because it was cash. They're just consuming back. The inability, because of just the scale of the problem of going to market, educating the market, getting the conversation aligned, that CFO's got to walk into a boardroom run by boomers, and most of the people in that room in a board of a company that's got $10 million of cash in the bank with no plans to use it, they're in their 50s, probably in their 60s, and are concerned about one thing first and foremost: will the shareholders of this company sue me
Yeah.
for malpractice as the fiduciary board member of this company? Can this go wrong and burn the $10 million, which again will revert back to me getting sued by the shareholders? Will this violate some kind of rules that will then have the tax, securities, any one of the alphabet soups of IRSs and SECs and FICO and blah 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 show up at our doorstep and have long and painful and uninteresting conversations with us that again will revert back to shareholders suing me? And unless you can massage me of all these concerns, leave the money in the bank, have our 10 million turn into 9 million. Is 100% of the rational answers that until all of the problems that wrap up into those things can be resolved. That is a sales challenge. That is not an engineering challenge. It's not a marketing challenge. Like, all of these things work together, but it's a person who's a salesperson who walks in and works through, how do I get the CFO in position to make that argument to their board successfully so that they can adopt our technology? The simplest technology in the entire space, a stable coin at a regulated financial institution that does the core thing that every business on earth needs to do better, faster, and cheaper: move money.
Yeah, that makes sense. So why do you think like the banks are not really into this then? Like it's very commonsensical, right? Is it that they are kind of worried because it's not quite regulated?
Circles is regulated is more Circle is more regulated than any bank you can name, precisely because they're scared to death of it. So all the banks in America spend a lot of money, an enormous amount of money, on, we'll just call it, government relations. They got people on Capitol Hill, they got people at the SEC, they got people at every regulatory body having conversations with those regulators and those legislators at all times. Hundreds of millions of dollars spent on that. They have an additional layer of the vast majority of people who work for a bank work in compliance in one way, shape, or form or the other. If you are counting numbers inside of a bank, which is what a bank does, it is in order to feed that number into a compliance regime, into a regulatory regime, to say, is this bank solvent or not solvent? Are we making money or not making money? Big four accounting firms are totally aligned with that. All the law firms around that are aligned with that. Who makes the laws and who makes the rules? Lawyers, accountants, and former bankers. It's not a political science challenge. It's very straightforward. You just look at where do they work after they work there? Oh, they work there, and where do they work before they work there? They work there. It's all very incestuous and very clear and very, 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 very valuable. Because the only business that America's in for real is financialization.
I see.
All that's wrapped up. So if there's 80,000 people who work at the bank, 70,000 of them, that's probably wrong, because there's a bunch of bank tellers and stuff like that just moving paper around that shouldn't be moved. But your grandma still wants to go into the bank and see a person. But a huge amount of the capital is like spent on compliance.
Hmm.
Blockchain solves, where are the dollars? They're all right there. Where do they go? They went right there. Who's on the other end of that? Let's figure it out. Who's on the other end of that? You'll know the answer to all these questions. 100% reserve, no fractional. It's the value proposition is very, very dangerous to their core business. That is the biggest business on earth.
The central bank.
The central bank rolls into It's all, you don't have to listen to Bitcoiners very long to follow that rabbit trail to figure out why this stuff's so threatening. Circle's in a direct attempt to make it less threatening because they're still using the dollar system, blah, 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 blah. There's still a huge resistance to that because it's like, why is it T plus three? It's not T. There's no technology engineering problem that makes T plus three a thing. The bank holds on to your money and works with it for three. Both banks. In fact, there's usually like 4 or 5 banks in that whole daisy chain, all working with that money you're trying to send to mom for free for multiple days.
And also charging a fee for it.
Not just for free. They're making a profit off it because that $40 wire fee that you paid is 100% profit.
Yeah, yeah.
Then whatever you're wiring, all of them and their corresponding banks and the finishing bank, the bank where it's being received at, are all playing with it, fractionalizing it. So if you're sending $5,000, they're all playing with some version of $500,000 in their super business, their super profitable back end business model. There's zero desire to break that. That is the business of the bank. The banks make the laws, zero mistakes, because guess what? Oh, Mr. Senator, you don't like that? We won't finance your campaign, and all. We'll have to review the mortgage on your house. Banks are, the only people more powerful on earth than a banker are generals. And American generals are just as owned as the senators. They've been financialized too. They're all like, I want my job I want my job in the military industrial complex after. I won't mess with that.
So recently, right, I think Tether got in a lot of trouble, especially compliance troubles and regulatory troubles.
Yeah, I mean, it's when you look at these technologies, there's a level of the incumbents pushing back, right? So it's just like they're looking like if the SEC was if the regulators were looking for trouble and were really serious about it, HSBC would be put out of business. A bunch of other banks would be put out of business. No one launders more money, banks more criminals by any standard of criminalization you'd like to achieve than actual banks. There's just not enough willpower, horsepower to go solve that problem. Whereas, like, if we send 10 investigators or whatever to go look at this crypto company that's 10 people total, we can figure out really fast what's going on there. And it's in our interest to get rid of them and prove it. And there are absolute scam artists running crap, and they should be put away. There's bigger, more effective ways to use the regulatory regimes than going and pick on somebody who's sold JPEGs illicitly. Um, because ferreting that out is all well and good, and not, criminals are criminals, but criminals, go find evidence, put them in jail. But the majority of this is like they're technology experiments. Some of them are going to go wrong.
Yeah.
I read the Terra Luna white paper.
Oh, yeah.
Looks like, smelt like, acted like a Ponzi scheme. But didn't quite know how. Like when it kept going up and lots of people kept piling money, and I had fear of missing out and some FOMO of, well, maybe I didn't read it correctly. Maybe I don't understand it. Maybe these smart VC types that have billions of dollars of assets under management, which is some indication they might be smarter than me, know something I don't. Turns out not to be the case. But, yeah, it's classic crypto advice. Do your own research, verify, don't trust. Look at this stuff and go like, I wasn't convinced any of my like I was running experiments when I was buying NFTs. Didn't put the house on the line to buy any of them. That would be foolish. I am sure, 100% sure there's people who mortgaged their house and went and bought a crypto punk, and that might have worked out well for them. The amount of risk they were taking was off the charts. But when you take that much risk and you get it right, you get a disproportionate reward. It's risk reward economics. Like if you pack your own parachute and jump out of the plane, things will happen, good or bad. There's no indifferent in that particular circumstance. So I don't feel bad. Like even the ICOs, all that kind of stuff that popped up. It's like there isn't there the effort that had to go through to create a MetaMask wallet. Fun, I got to go on to Coinbase or some version thereof, buy some crypto, send the crypto from Coinbase to my MetaMask wallet. Then I got to go find the smart contract to interact with, send ETH or whatever over that line into that smart contract, get back whatever ERC20 I was getting back in return, hold it. That that was a lot of effort.
Yeah, yeah, yeah.
The vast majority of humans have demonstrated very explicitly and clearly either they're not interested, not listening, not listening, but vast majority to like anything on earth. Like most people aren't paying attention to 99.99% of things. Those who did listen didn't care. Some who listened most didn't engage, they even got down that funnel. And then the hurdle between like, so I gotta go KYC myself in exchange. No, I'm not gonna do that because it's hard, it's annoying. Then I gotta buy, what do I gotta buy? Do I buy Dogecoin or do I buy Bitcoin or do I buy ETH? I don't know. Oh, I figured out I need to buy ETH. Okay, got it. Boom. Now I need, like, how do I set up a MetaMask? Like, there's like 8 to 10 things
Oh, yeah, yeah.
that these consumers that these regulators are supposedly protecting had to go through to buy the scam.
Yeah.
Don't like the level of empathy anybody should have for someone who got smoked by Terra Luna is very low. Like I am 100% sure that there's edge cases that people were conned and done, little old ladies in South Korea were probably taken advantage of in some kind of way, shape, or form. That's a structural issue. If I got taken advantage by Terra Luna, I got taken advantage. Like there's nobody accountable for that but me.
Yeah.
And if someone like me who's like I read the stuff and I looked at it and I did it, got smoked, zero empathy. None.
Yeah.
You deserve absolutely 100% of what you got because you'd be throwing yacht parties if it went the other way. And they were. So when the 3 Arrow Capital guys get perk walked, I don't feel bad for them. They were walking around like rock stars, having the whole world go, "Wow, you're so smart." No empathy, none.
You also mentioned like a crypto project which you are working with a beer company.
Yeah, so that's one of the paths that we work. So Factorchain.ai is the kind of core company, core startup that I'm working on. Our right back to start, like combining the use of data in DeFi to create real world loans to real world businesses. And in the case of that, like our target market, our kind of example market that we use is craft breweries. So local, small batch breweries. So it's not Anheuser-Busch and Budweiser. It's the local craft brewery that makes 10,000 hectoliters of beer, which would be a pretty big craft brewery at that. Um, so we're lending them stablecoin based on the data from their business. Essentially, we tap into their business, ask them to kind of subscribe through API optimally. We'll get spreadsheets and all that kind of stuff too, do it by hand, but like optimally we'll get API calls through their QuickBooks and a plaid call to their bank account. And usually there's some kind of um, operating system for the brewery that's managing inventory and the brewing process and all the kind of stuff that goes into making beer and running the factory that is a brewery. Get as much data out of the business as possible. Use AI, aka statistics, to analyze that business, figure out what the ratios of it are,
Yeah.
understand what the credit worthiness of the company is, and then specifically look into the forward forecast of sales. So the difference between us and a bank is the bank does credit worthiness of how much balance sheet is here. Typical small business loan will be okay. If there's $1 million in the balance sheet, we can loan you up to $3 million. Right. So most breweries have some version of the $3 million of business loans that attach to their $1 million balance sheet. We're like, we're much more interested in if we loan you money, can you sell more product or sell the same amount of product but sell it more profitably because we've put more money into that forward forecast? So essentially, we want to get an understanding what's the current state of the business, just like the bank does, of what's on the balance sheet, how much cash flow do you have, all the kind of usual bank stuff that can be done by an algorithm. No bankers required, only algorithms required. How would you run a bank in 2022? It'd be an algorithm. The So we run that algorithm, and then we apply some level of data science on top of that algorithm. We're like, what's the forward forecast? If we put more capital into this, can they buy more efficiently? Can they sell more efficiently in order to generate more additional contribution margin back to the business, or sell more product that will contribute more margin back to the business? So it's similar to factoring. That's what we call it Factorchain, but it's it's all about growth capital. So how do we use debt to grow that straight line, traditional block and tackle local business that's got very cash intensive. So a well run craft brewery is a 65% gross margin business. Even if we only turn that into a 60% gross margin business, because 5% of that goes back out to cost of capital less, as long as they're increasing the number of increments of 60%, they can achieve, that makes a big impact on their business. And most small, medium sized businesses like that are kind of debt optimized. They've taken as much debt from a bank as either they can or are willing to. The willing to is, well, there's only, rational business person only wants so much debt. Obviously, people in this environment are going to try and reduce their debt. It's going to it's going to go from cost me 3% to now it cost me 12%. The 12% is a real number. 3% is like 3% is literally a rounding error. 12% is like, no, I'm going to pay attention to that. the and it's the pain of going through getting a loan from a bank is a big lift for a mid market. It's You got to show up with your personal tax filings for the last 3 years. You need to audit your business for the last 3 years. Most small businesses have personal guarantees of no, it's not the brewery that's the collateral, it's my house that's the collateral. As the brewery. So like they don't want to like breaking out the shoe boxes and doing all the work they got to go do to get the bank to align. It's going to take them 3 months of work to get to that one that's relatively predictable. We're like, no, let's do that in 3 minutes with an API call. Is our advantage, and it's because we're not as acutely interested. We're not trying to run a compliance project. We need to be compliant. We need to know what the business is. We need to know who it is. But it's like I don't have 75 people in my back office looking for work to do. I have an algorithm that just wants to do some math, and I got one person that checks the math. And the occasional spot check of the engineers going like, are those APIs right? Are we actually attached to the right thing? And we're not getting spoofed, right?
So this is essentially a credit business, isn't it? You're giving credit to businesses.
100%.
So if you are giving USDC to a brewery, for example, how do they actually use the USDC? Do they directly use the USDC, or they?
We partner with firms like Circle. So in the United States, we partner with Circle. Circle will convert those tokenized dollars, the USDC. They just automatically convert it and send an ACH over to the Bank of America account for that brewery. And in Canada, we predominantly do that in Canada because I'm based in Canada. A bunch of our first customers are in Canada. We have a partner company similar to Circle up here called Stable Corp. So Stable Corp's similarly structured as Circle is in the United States, but for Canada, they do the exact same thing. So essentially, they send digital token. They are the issuer of Loonie stablecoins, the Canadian dollar stablecoin. They issue that. We loan that out. Customer gets that through a portal. They go to the portal, say, okay, we actually need Canadian dollars in our traditional bank account so we can go spend them. They just push button, done. And it's a inexpensive fee that StableCorp collects on that when they need to do it. And then we're evolving that to a status where even though we're issuing this as a debt out to the brewery, typically the breweries are not taking all of the money, firing it right back at the door and putting in the working capital. Usually, like, okay, we'll use half of it or we'll use a chunk of it. They can essentially stake that those dollars that are at rest, those digital dollars that are at rest, and stake them and earn an interest rate on against them as they go off into DeFi pools and things like that. And reduce their overall cost of capital. So instead of it, we might be charging them 36% APY. The beauty of our loans is because they're digital. I can loan you stable coins for a day. I can loan them for an hour, and there's not an overhead material there. There's a reason why banks want to do 30-day and 3 year and 5 year loans is because it costs them like $50,000 just to do all the paperwork to figure out how to do that. So we do it an API call and then send the money digitally. Our overall overhead at scale is zero for all intent and purpose. So we're able to,
That's actually very smart.
yeah. So it's like such a using the technology. We're just doing the technology enablement of like stable coins allow us to move money better, faster, and cheaper. Algorithms allow us to underwrite better, faster, and cheaper. So we're just trying to hit the intersection of that, optimize that, run the chain, scale it. Right now, we do 30-day loans, not 3-minute loans, but like at scale, that technology can run a 3-minute loan all day long. The algorithm will go, can we loan it to them? Yes. Here's the dollars. Oh, smart contract will automate that stuff. It'll all be automated.
So there are breweries who are using your loans as of right now, like it's live.
Yep. Yeah. Very small. Like we usually work with 2 or 3 breweries at a time just because we're working our way through developing all the technology plumbing. And a lot of that had to do with just the infrastructure to exactly your question of, well, how do they turn the stable coins into fiat and then pay and then the stable coin? It was like there was a big regulatory lag in Canada in particular getting these things approved. There was some technology stuff that had to get done. The technology stuff was done 6 months ago. The regulatory stuff,
That's taking a lot of time right now.
a lot of time, and then it's just scaling up the amount of dollars we have to put to work. And, it's customer acquisition. So it's just we're still in the proof of concept stage of building out how does all the technology work underneath the hood in order to get the algorithms to work correctly and be reliable, all that kind of good stuff. So we're doing block and tackle kind of 30-day to 90-day loans, usually in the 25,000 to $50,000 size. So we're not doing large loans.
Are you guys like raising money to give out the loans, or is it your own money that you are loaning out?
Currently, it's our own and some partner capital. So, like Stable Corp's got a large investment wing that's trying to prove their own technology along with our technology by putting some additional capital on that. So, it's a combination of Factorchain's balance sheet capital as well as we have money from Stable Corp as our partner doing some of that. And we've been in the process trying to raise capital from different sources. So, family offices we think is probably going to be the primary funder of that type of opportunity. But a bit of that's like we got to crawl, walk, and run. We're somewhere in the crawling to walking transition phase. So we're having lots of conversations with potential capital allocators in that space, mostly around them allocating some level of equity to help us build up the technology further. So it's more and more automated because there's only some like the current size of scope what we can do is very limited by how much time I literally how much time I have a day to go into MetaMask and send money around and move it around versus you know getting more engineering in place to automate more of that. And then obviously we want to be able to deploy more capital. So obviously that's good. For us to get into the 7 figures of assets under management to go loan out that capital is kind of the next key stage because the core of the product technology enables it. Technology is not the product; it's the enabler of the product. And the product is money. It's loans.
In a traditional bank, right, they have like access to a lot of capital to kind of loan out. But when you are trying, here essentially you are trying to be a bank in the sense you are going to loan out money. So when you're loaning out money, right, what is like the success metric for the business? Is it how much money you loaned out, or is it okay how many checks you're collecting every month?
Uh, so it'd be a combination of what's the return on capital. So just simple math. We want if we had $1 million going out on loan to make that compelling and interesting, it's going to have to generate at least $360,000 in interest income. So essentially at the end of the year, you want to have $1.36 million in that loan pool. the real mechanism to that is churning it more often. So like the real advantage that the technology, when it's implemented correctly, so DeFi plus data gives the ability is instead of turning that once, so the implied, if I lent out $1 million and for 12 months and got it back, I get, in this model, we get 36% back. Um, the idea would be, I want to, that'd be one turn of the million. What I really want to do is churn realistically. We want to turn that $1 million at least 12 times. Ideally, we want to get into the neighborhood of 24 times. There is not a financial institution on earth that achieves that kind of churn. And so the ability to turn multiply that 36 $360,000 of interest rate is a lot higher if you turn it a lot higher. So part of that's getting in the what does that really look like? What does the economics of that look like? Does it double it? Does it triple it? Some of that's understanding what our costs of operations really are. Um, how many engineers do we really need? We're kind of working our way out, and then there's a level of risk and compliance that you got to put on the back end to monitor that and all that kind of stuff. So we got to get into the spot where we know what that looks like better, but the core is the asset under management. So how much that can we have? We'll make real money if we have tens of pretty much blocks of $10 million to loan is how I look at it. How do we scale? It's going from 10 million to 20 million to 100 million in terms of capital alone, because that'll generate the cash flows from an interest perspective that get interesting. But then it becomes, how does that different than any other bank's ability to do it? It's like, well, how good is our risk? Is our risk analysis at least on par? So the amount of bad loans that we do, or breakage in time, whatever we do, whatever the breakage is on that those loans is, it's got to be at least competitive. But the winning combination is we've turned it way more times.
So if you turn it a lot of times, right, is it also cheaper for the end customer?
Yes.
So like how cheap?
So like, someone tells you, like, I want to loan you 36 at 36% APY. Like that's like double credit card in a lot of and for a corporation. There you go. Like, well, I don't have that loan. It's like, no, because the value proposition is I'm going to loan it to you for 2 or 3% for 30 days, and that if I loan you $10,000 for a month and it costs you $300, you're like, okay, as long as if I can go make $900 additional margin off that, I'll pay you 300. Here's $300. So it's all that it is aligning that value proposition of our value proposition to our capital allocators is we're going to turn your capital more often, and turning that into value proposition for the borrower is like, I have capital on demand for all intent and purpose, because the only way that kind of capital on demand has been achieved in the traditional market space is through lines of credit. And so like the answer the bank has for we don't understand anything about your business is a line of credit. Right. So it's like everything else is balance sheet based, and then that line of credit is lined up with the balance sheet and the cash flows of the business. So they kind of just take that math and go like, okay, if you're turning over this much money, we'll give you $1 million line of credit. We'll give you $100,000 line, whatever it is, and the entrepreneurs can use that to do whatever they want, and essentially like incur a 12% interest or what have you, depending on the market and space. But typically around 12%. It's like, all right, well, we need to be more targeted and give you more financial flexibility with our ability to put this money in place where you need it more accurately and with less impact on the balance sheet. So that part is what that we're trying to thread the needle on is where does this sit in the balance sheet calculations of, if you put a CFO brain on, all right, if I'm pulling $100,000 a month, so I take two $50,000 loans or what have you from Factorchain, how does that impact my capital ratios and my cost of capital, my overall cash flow? So our job is to identify is like, how do we smooth out the cash cycle and make the cash cycle more efficient for a CFO? And so that's what we'll have found product market fit when we know what the answer is to that more effectively, other than here's 50 grand, go sell more beer, which is what the current answer is like. oh, if I borrow that $50,000, I can buy more cans, I can can more beer, and then I can sell that beer. I can sell it a month or 2 weeks sooner than I would otherwise. And if I can pull forward that margin, I'll pull. That's worth. It's worth the $500 interest that we're going to have to incur to pull that forward. And that's why they're doing it, because it's that 50 grand is probably like, well, I got to keep my line of credit to pay payroll and then do all this stuff. So I'm kind of capped out. That's where we've done the half a dozen loans that we've done is in that zone of line of credit's not the we're not going to use our line of credit to do that. We're going to go use your capital to buy an input. So usually it's been cans. Some other cases it's been barley. So they bought it earlier because we pulled forward cash flow by 2 weeks to a month because they're waiting for a large retailer to pay their invoice. And so we just kind of factored the invoice for all intent purposes. What we've done.
And do you have to like register as a bank to do this, or is it like a normal LLC C corp?
Yep, C corp. Over time, we'll have to look at more regulatory rigor, but the movement of capital, so like the money services business, is the kind of stuff that you need in the United States and Canada around that. It's like that's for us. That's covered by our partnerships with Circle and Stablecorp. They're the MSBs. They're the mover of capital. So they're doing KYC, AML on all the transactions. We're doubling down on that. So essentially, we bring our client forward. They do the KYB process so that they know who the counterparty is, and the money runs through that way. But over time, as we grow more, like right now, we're literally moving low six figures of capital, so it's not a regulatory environment yet.
I see. Like I checked out the website, but I don't think there is a lot to see on the website.
No.
So is it like on ground right now, like talking to people face to face, and that's how you deal with the whole thing right now? In a sense, you're not scaling up marketing.
No, we're not in the scale mode yet. It's still trying to scale the back end before we scale the front end. It's kind of validated basic proof of concept from a value proposition perspective. It was like we need to raise more capital to allocate to generate more demand, and then in order to actually service more demand, we need to build up more technology. Otherwise, it's just going to turn into a lot of me running around swapping capital, trying to keep track of that, and that's we need software to do that, not my brain, because my brain is not detail oriented in that manner. I'm not a banker for a reason.
I'm not even sure how you came up with the idea actually. I'm trying to figure that out. In the sense, I understand the CFO part that you look into the balance sheet. So you're basically giving the business a CFO which they won't hire on their own, or at least that's what I understand from it. And then you will kind of help them make a better call as to when to take the money, how to use it, and how to also kind of pay for it so it does not cost you a lot of money.
So there's a bunch of elements of that are correct. The how we got there was looking at supply chain optimization, because blockchains and supply chains are supposed to be kissing cousins and work together. And the path to success for a supply chain is supply chain visibility. So it's essentially getting as much data as your supply out of the supply chain as possible, seeing as many of the moving parts literally as you can, and then using that data to make make better decisions, do better operations, and then move that supply chain better, faster, and cheaper. And so we looked at that initially as like the target market that we're exploring. To go like, okay, do you use some kind of decentralized ledger technology, blockchain technology as the single source of truth, allow communities to collaborate, because there's a lot of intermediaries in anybody's supply chain. So there's the shipper and the receiver at one end. Usually there could be 5, 6 parties in between them. The shippers and receivers are using a lot of the same vendors in between. Lots of other parties. So there's all kinds of ways to build ecosystems around supply chains, and part of that is like sharing more data will all boats will rise if you share more data. But how do I share that data? Like the advantage that Walmart, Amazon, FedEx, and Procter and Gamble all have is the economy of scale that allows them to absorb as much of that data as possible. That's their competitive advantage. So letting more people participating in that and sharing the value of their advantages, I can see more because I can spend more money on seeing it, and because I see more because I spend more. They have this perpetuating economy scale cycle. So the only way to break that is Web3 technology is the way to break these monopolies by decentralizing out the value. So we were exploring with that essentially the value that you see pretty quickly when you look in how to the only way you're going to incentivize someone to do something abnormal is with money. It's no different than my DeFi protocols I may have made fun of earlier. It's like I need to pay you a lot of APY for you to come bring your asset over to my DeFi protocol so that my TVL will go up. So how do I get a participant in the supply chain to give me their data? I need to give them money. So I want to loan them money. So it's essentially we started to find out, all right, what's the biggest risk? The biggest financial risk in a supply chain is the disjointedness between your accounts receivable and your accounts payable. So your cash cycle is how that goes. Of like, if it's going to take 30 days for the product to get from my factory to its retail outlet, and so I got minimally 30 days where I'm out of pocket as the manufacturer. So I need cash to keep manufacturing more things so I can stay on cycle. So there's a whole cash cycle that goes with that. Then there's all the shippers and receivers that move product in between. They get locked into these different account receivable, account payable cycles that cascade down. And then ultimately when the product might get to a retailer, the retailer typically has a lot of power. So if it's a Walmart or it's Amazon, they're going to be like, yeah, even once we receive it, we're not going to pay you for a lot of cases 90 days. So there's this huge disjointedness in cash cycles of all the participants that are going to transit from we built the product to you sell the product. It's got to physically move. There's a lot of disjointedness in that market space, of which the banks make lots of money. But they're arbitraging that whole market. Anybody who spends a minute in DeFi goes, why can't I arb that? Why can't I make that more efficient? How do if I use stable coins, all that money should move faster. Now, as soon as it leaves my dock, goes into your truck, we should transact. The legacy of these, like a 30-day payable, is horse and buggy. Like someone had to physically move the money. Was part of like how that, and then trade finance is a whole financial engineering project unto itself. But as we've seen in DeFi, you can take all of the financial engineering and you can start to codify it and put it into protocols. You can get exponentially more efficient. So we started. That's how we kind of got to the concept of like, well, let's put DeFi into these supply chain transactions and get what do we need to make that valuable. So essentially, we're pricing data. What's the value of the data that we're getting out of this? How do we use that data to turn into a risk score? If we get the risk score right, then we can create a cost of capital calculation. And that becomes like essentially it's a data valuation model. Is the highfalutin idea is the data valuation because of my kind of one of my theses is the most valuable thing on earth, potentially one of the most undervalued thing on earth. Let's say that is data. Look at our most valuable companies. What are they? They're data companies. Why is Alphabet valuable? It's worth $2 trillion, give or take a $500 billion.
Yeah. Yeah.
The only thing that is there is a database.
Yeah. A very big database.
Yeah. So let's say they're worth $2 trillion. $1.5 trillion of that balance sheet value is data. There is no line item on any balance sheet on earth that's data. So we're kind of looking at like that will change.
Yeah, in the sense, when you learn blockchain for the first time, they keep on kind of try to sell you an idea that blockchain will revolutionize supply chain, and you just kind of keep on hearing that. But those kind of companies or projects kind of they never make the news, the things from blockchain that kind of makes the news are NFT projects, or things like that. So I would say after a very long time, I have heard a project which is very much on ground, which takes into account the reality of the actual business, and who is trying to, I would say, take the things that blockchain was made for and kind of apply it to a real business, which I think what you guys are doing right now.
Yeah, I mean, like we're trying to use initially like pretty lightweight blockchain technology of like just stable coins, right? To move those around, move the money better, faster, and cheaper, disintermediate banking counterparties from both us and our borrow, so that the money moves cheaper. That lowers our operating expense, and allows us to do things for the customer that are like get them money quicker, get it money to them cheaper, and get it back from them quicker and cheaper. Like that's core. Over time, we want to build these data value networks. So another piece of the project on the back end, Factorchain, is called dvnet.io. So data value networks. And what we're going to do is we're decentralizing and tokenizing the value of the data that come out of these ecosystems. So, like in my example of craft breweries, we build a craft brewery data ecosystem. Says like, okay, there's tens, dozens of breweries that are contributing data in order to get loans from Factorchain. We're gonna pool that data in a way that all the participants get value from it, protect it with zero knowledge proofs and all the kind of cool technology stuff we know, so we don't know which brewery it is and what their gross margins are, what product they're selling, where and to who and when. We're just getting the data signals and translating those data signals into value. Like the obvious value to Factorchain, we'll be able to underwrite better. A whole bunch of other players can come at the ecosystem and go like, oh, we can help you ship the product better. We can help you manufacture the product better. We can help you group purchase more effectively. Because it's like the classic, why are craft breweries and not international breweries? Economies of scale. Anheuser-Busch can buy aluminum cans exponents more efficiently than any craft brewery on earth. It's quite like even all the craft breweries on earth, if they were group buying, might only get to the Anheuser-Busch level. They got to incrementally get there. Like all the local guys in a local region said, like, shoot, if we just bought it all together, we'd save 10%. That's a big win. In fact, the only way you can do that is you got to get visibility and insight to like, oh, we got 17 breweries within 10 square kilometers, which is not unusual. No, call it 25 square kilometers. You're probably going to hit 10 breweries, no problem. At least on they all buy barley and hops in cans, guaranteed, like 100% guaranteed. They buy it. Most of the time, they buy it from the same one or two vendors. They all buy it individually. What can Web3 do for them? The coordination expense amongst 10 breweries within 25 square kilometers of each other. How many phone calls is that amongst them? And then out to the vendors to go, we'd like to group purchase a lot. That is the classic school group project of some poor sucker gets to do all the work, ends up presenting it, and quits the co-op consortium of the local craft brewery gang that wanted to buy cans together. Only way you solve that problem is a coordination technology. Web3 is a none of them want to give up their competitive advantage. None of them want to give up their individual data. Certainly, like they compete with each other. Like they their their primary competitors are the Budweisers and Molsons and Coors of the world. They don't particularly see each other's. They're cooperating together more than they're competing with each other, but they're competing with each other because there's the big guys and then there's the craft brewers, and they're all trying to get their slice of the craft brew and trying to, but they want to grow that pie of craft brew sales, so they want to take it away. Buying cans isn't a competitive advantage. The problem they have is like, I'm not going to be the guy who makes 10 phone calls to the other 10 guys and then calls the vendor and then has to make another 10 calls, and it turns into another 10 calls so we can all figure out that we all want to buy how much cans we want to buy, get a deal, coordinate all that stuff. That's got to be done through a shared data network that if they don't own it in their own ecosystem, protect it correctly, they're never going to do it. They'll just keep doing their own thing. So we're trying to figure out how do we apply Web3. But step one is get the business transaction of like, what's the business? Like, well, we'll loan you money. What do we really want? Yeah, I want my money back plus interest, obviously. But what I really want is data. And I'm going to protect your data and keep it safe and privatize it and do all the kind of things that we can now do with all this modern technology we've come up in the last 5 years. Just going to do best practice from it. And we'll start to generate insights. Those insights are only so valuable to Factorchain as a lender of money.
Yeah.
We got to go like, oh, I can be the group buying app that helps you guys figure out how to buy cans together. Click here, click at the button versus 10 phone calls. All of a sudden, it's like, yeah, I'll get my cans on Tuesday instead of Wednesday. I can deal with that. Save me 10%. It's a good win. If I buy like $5,000 more of this stuff, we'll save $5,000 over the next 3 months. I don't have the $5,000. Factorchain, happy to loan you the $5,000. So it's a hopefully a virtuous cycle. We gotta prove that concept out, and so the DVNet's kind of the back end project that we have partners on that we're building. That's kind of the real Web3 native application that we're going to put behind that, because like Factorchain's business is like no stable coins. It's not that Web3 sexy. It's like no, we're using stablecoin rails.
So when you are building a project like this, which requires so much tech, right? How do you kind of predict, okay, how long it's gonna take to just build out the tech?
Entirely too long. So not having technical co-founders that have stuck with the project because they've gotten enamored by let's go make DeFi smart contracts and do other NFT projects and stuff like that. They've run off and chased that gold versus go after this more real world practical application. And for most part, those a couple of technical people that we've had in the project have done just fine by making those decisions. So it's been a slow roll, but we've been much more focused on what's the business calculation? What is the business model here? What business value are we generating? How do we turn that into a standard operating procedure that can scale and that works and that services all of the stakeholders and most importantly the clients in that process, and figure out what that design space looks like, and then as no coded as possible. So you know, we could have gone and built our own stablecoin. That doesn't make any sense. That that's taken years and millions of dollars of regulatory compliance work by those parties that go do that. So we use it. The I don't need to reinvent what Plaid does. Plaid can go get me your bank data. I don't need to reinvent what QuickBooks does. QuickBooks got all the GL data. I just need to hit. The only tech we need to do is like how do we extract, transform, and load the data that comes off the backside of those APIs, put it into a data lake, run the algorithm in the data lake. So that's the only part we're focused on now is this kind of like how do we build the database? How do we query, how do we drive our queries into the database? And even none of that's rocket science. That's really straightforward. We have engineering partners around doing that, but that's, we've done the spreadsheet version of that to build the next stage. We got to raise some capital, and we got a 3-month project that we have a partner ready to go on, but we got to pay them. So that is the Q4 status of that project, is doing the dance with investors around, do you want us to put out more loans, or do you want to put equity in the company so that we can pay for the technology so we can do more loans? It's an interesting dance, especially given the market conditions.
So you are like pitching to investors right now, in a sense, doing meetings and trying to figure out, okay, how to do is it gonna be like a seed round or like a series A or what?
It's a seed round. So the seed round is like the basic MVP. Right now we have like a prototype is how we're, as I kind of said, spreadsheets that do this. It's an SQL database, but it's a spreadsheet that we do it on now. But the kind of productize that is what we're going to put the seed round into. And the seed round would also kind of ramp up the website, put more marketing on it, because this part of the seed round will be obviously pulling through more capital. We can go loan now. In that process, we'll have a more scalable platform because we'll be able to properly pay our risk analyst to do it full time, to do it full time versus part time, and all those kind of different things that we need to put in place that are we haven't done because we bootstrapped it.
So how do you value a company like this?
Pretty much in comparative models. So it's pretty much we look at stage of company, maturity of company, sector space that it was in. You know, we look at whether it's a $12 million or a $15 million pre-money valuation is the debate that we get in with investors, and part of that's just managing the cap table in a way that makes it success. Gives it the opportunity to kind of scale up and be successful. Like lots of entrepreneurs over optimize. I want a $50 million. Like, well, if you raise $5 million at $50 million per year post, doesn't matter. It's like you have to grow in. You need to be worth $150 million for your investors to feel successful on your next round, which should be 18 to 24 months from now. What metrics do you want to drive to make your company worth $150 million? Currently, that means you're going to need to be in the range of $15 million of annual recurring revenue.
Yeah, yeah, yeah.
Doesn't just magically happen anymore in the market. There's a bunch of these companies that raised on an idea that now have to figure out, like, oh shoot, we raised at 50 million bucks, and that $5 million is going to be burned down to the ground by summer of 2023. We have no revenue, limited revenue, $1.5 million of revenue, whatever they happen to be at. It ain't
Yeah.
15.
And are you looking into
And
AngelList
they're,
now?
and they're, and they're in deep trouble because of it. Because
Yeah,
they glamorous valuation, and like there's reasons to do that, but there's also the consequence of doing that. If you time that incorrectly, you're going to be stuck between a rock and a hard place where the down rounds are going to come. And that's well publicized and well talked about by all the VCs and all the podcasts currently about. No, when we valued it, you had 100 times nothing, or 50 million bucks because you got referred to us by the right people the right way and had some cool
oh
looking
yeah,
engineers and some cool
yeah,
things in the past. We decided that, yeah, sure, we'll give you 5 million of 50 million.
yeah. There is a lot of that actually, or I would say
That conversation
mostly.
is now 100%
Yeah,
over. It's the, do you have $15 million of revenue?
yeah,
Oh, you don't? You got $1.5 million of revenue? Okay, congratulations. Your company is currently worth $15 million, but we raised it 50 million. Uh-huh.
yeah, yeah, yeah,
And
yeah.
and the venture capitals will logically go like, no, I don't want to run your company, so there's no room for me to write the check because your equity in it will be next to zero. And so your rational motivation as an entrepreneur would be kill the company or figure out how to make it work on revenue. Happy to work with anyone who wants to go try and solve that problem, the revenue problem.
Which is kind of where we started off today. The yeah, yeah. Are you looking into AngelList for potential investors? Like they have a new platform to get funding and all.
No.
So you're trying to just get funding from probably Canada right now.
Yeah, we're heavily focused kind of on our partner network. So working with strategic investors. So that's kind of our point of view on that. Mostly because of the debt element of the company. We think that or to really actually get the company to the next level, the equity piece that we need to build out, get some runway and build out the technology is pretty limited. We think we need about $2 million to kind of put that 18 million, 18 months on it. Get some engineering in place, put some, kind of the back office capability in place is relatively inexpensive. It's to make that business model work, it needs, $20 million worth of debt capital. So it's kind of, we're doing the dance with the debt capital providers that get the, trying to do a, 10 of one, 90 of the other type deal.
And will this that or whatever decision is about of this dance will it kind of decide the future of the company in the sense the decision to take, okay, what amount of debt you take compared to what amount of equity you raise, will that kind of define how it goes forward?
Yes, yeah. So the company doesn't go anywhere interesting from a revenue perspective without debt capital, because it is the product that is being sold at the end of the day. The technology is just an enabler of selling the product that is capital. Um, so you just think about the basic math of, all right, if you're producing 20% interest rates in terms of like what's the net take of Factorchain at best, it's 20%, it's more like 10%. So, 10% of 20 million is 2 million bucks in revenue. And that's kind of the, okay, well, we burn down the equity, we replace the equity with revenue, you buy yourself the next window. Obviously, if that model is being successful, the equity proposition gets bigger, the debt proposition should get bigger, but we're trying to do the get the virtuous cycle going between the two, where it's like, what, the equity is worthless without debt capital to go loan. So that's why we're in a interesting space relative to being a Web3 startup or a fintech startup, depending on who we're talking to. From a capital perspective, we think the private equity family office money is more interesting because of the debt elements around it, and that those kind of investors understand what our competition fundamentally is merchant banks, and they understand merchant banks, they understand debt banks, because every family office has an allocation of those types of alternative debt investors.
I see. So, well, I would say this was pretty enlightening. I learned a lot, especially about. So, I would say when we started talking the first time, I was kind of confused in the sense, okay, how do you use AI in the sense data and blockchain together to build a real product? But then I would say it was pretty interesting to learn how you're kind of using data to kind of make better decisions in the sense, okay, who to give money to and how much. So that's pretty smart. And you're giving the money in blockchain in the sense you're giving a stable coin. That's also pretty smart. And yeah, I can paint a picture in my head now. Thank you, Scott, for your time. This has been great actually. But I hope you had a great time.
I did. I enjoy the questions because it makes me think about, like, all right, what's it? How do I? Because most of the time when I'm talking about it, it's with co-founders that are in the soup of all the context and all the background and all the biases of all the work that we've done. So it's like when you're trying to explain it to somebody cold, it helps.